if I set up my LLC for real estate investing, but I have not bought anything yet, can I write off the courses I have enrolled in to educate myself and equipment? They're educating their equipment. No, educate myself and the equipment as well.
Yes. So while one can deduct education expenses, typically if it's a new line of business, one of the things that we often do, we'll set up a C corporation. There you could deduct new line of business expenses. But here, depending on this LLC is taxed, and you say you're getting into real estate investing, which probably means a rental. That's something, an appreciable asset you wouldn't put into a C corp. We typically would put that in maybe a disregarded LLC, disregarded to you. And there you would not be able to do education expenses if it was, again, a new line of business. As far as the equipment, you'll probably have no problem with the equipment, provided it's reasonable and necessary for the business.
Is there an issue with the fact that it's investing? Would you be able to write off education ever with investing?
Yeah, that becomes real difficult with the investing. Is if it is true investing of nature, then probably you wouldn't be able to deduct. There isn't any place in the tax returns to deduct something like that. So if we actually are using the term investing in that we're just kind of sitting on the sidelines, then probably you wouldn't be able to deduct it even then. But if you're using investing in the sense that you're going to go out and get a rental property that you are renting yourself, then again, it would be, as I said, you probably need to set up a C corporation to take that deduction.
Yeah, so it comes down to do you have a trade or business that can write it off? Investing, you get very limited on what you can write off, and especially like stock, you can't write off anything that's education or conventions or seminars or anything like that at all, period, unless you are a trader in securities, which means you're trading more than 750 trades a year, 70% of the days, and it's your major source of income. Really, really, really tough to meet. And like, I wouldn't do that to somebody. So the easy thing is to set up, like Elliot said, is you set up an LLC tax as a corporation or a corporation, specifically a C corp, because just by being set up, they're a trader business. They don't have to meet the profit requirement and all that jazz. The other thing is, when we used to try to write these things off, where would they go? On miscellaneous itemized deductions. So that was pre 2017. You could try to write them off to the extent they exceeded 2% of your adjusted gross income, which most people phased out anyway. There's actually a really good case called the Woody case. That was Woody v. Commissioner, because it was a gentleman by the name of Woody, not from, what's the Toy Story? It's not that Woody.
Yeah.
It's Mr. Woody. But they went to a course. Actually, we had spoken to this individual and held the position that he couldn't write off what he was trying to write off. So he went to somebody else who did allow him to deduct it, and he got audited and ended up being a tax court case. So like, we recognized it. We're like, oh, wow, we remember that. We told him he couldn't write off, and guess what the court's telling him? You can't write it off. It wasn't rocket science, but what it was he was a flipper. That's a trader business. You're not a real estate investor when you're flipping. You are a dealer in real estate. The problem is he took the course before he flipped a property. And so let's just use this year. This would be like he took a real estate course in 2023 and he bought his first property in 2024. Well, you can't take the deduction. You're not a trader business yet. You're not in existence. You're not doing the activity. So he lost the deduction under those circumstances. What is the worst thing that happens to you when you do it? Let's say that you did the education and eventually you set up a corporation and you're using that education as the means of why you're setting this up and you're implementing a plan. You could always grab it as a startup expense, and up to $5,000 you can immediately depreciate and write yourself a check for and reimburse. Otherwise, it's 15 years, anything over that. So if you're spending a lot on education, and we have clients that spend, it's not uncommon to see $30,000 to $50,000 to $70,000 with some organizations that are more on the higher end. They'll end up spending quite a bit of money on education. In that particular case, you want to make sure you have either an ongoing concern or you have a C corp, or an LLC taxes a C corp that's grabbing those expenses. Worst case scenario, you're writing it off over a portion of it off in year one and the rest of it off over a period of 15 years, but you're not losing the deduction. If the business fails for whatever reason, you can write the whole thing off when you dissolve the company. It actually becomes an ordinary loss instead of capital loss. So that's why whenever you're doing these, talk to your tax and asset protection professional when you're going into these, before you start spending some real money, to make sure that you don't end up in a situation where you lose a deduction. I don't know a way that they're necessarily going to grab it unless they set up a corp, right?
Correct. Yeah.
I don't think that they would get it as an individual. Any clarification on that? No. Great. All right. So let's move on.
If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.